As GLD marks its 20th anniversary, let's reflect on how this gold ETF and the S&P 500 Popular ETF, SPY, have performed over the past 2 decades. This isn't about declaring a winner, but understanding the distinct roles these assets play. Gold, often a hedge against inflation, uncertainty, and volatility, adds stability to portfolios, while the S&P 500 drives growth and dynamism. By exploring their performance, we'll uncover how they complement each other in a balanced investment strategy. For most of 2024, gold had been outperforming equities, but after the U.S. elections, it faced a correction, while the S&P 500 surged. This divergence highlights how gold and the S&P 500 can behave differently, even under similar market conditions. Leading up to the elections, gold rose, driven by inflation concerns, global economic uncertainty, and geopolitical tensions, such as trade wars and regional conflicts. However, after the election results, optimism about a stable political environment and new fiscal policies sparked a rally in the S&P 500. At the same time, gold, traditionally a safe haven asset, corrected as investors regained their risk appetite. This kind of divergence isn't unusual. Historically, gold tends to thrive when inflation fears rise, geopolitical tensions increase, and investors seek a store of value. In contrast, the S&P 500 typically outperforms when the economy is stable, corporate earnings are strong, and investor sentiment is optimistic. Though they occasionally diverge, at times they perform well together. This usually happens during periods of economic recovery with inflationary pressures, or when stimulus measures and low interest rates help both equities and gold. In 2024, the post-election rally helped the S&P 500 surpass gold, showing how equities can lead in times of optimism. Nevertheless, gold remains a key asset for hedging against inflation, geopolitical uncertainty, and financial instability. Despite short-term fluctuations, its long-term appeal endures. Both assets play a crucial role in a diversified portfolio, excelling in different market conditions. Let's compare the 1, 5, and 10-year dollar-cost averaging returns of the SPDR Gold ETF versus the SPDR S&P 500 ETF, SPY. Note that this is not to determine the winner, but to provide an indication of their performance. Often, both are part of a portfolio, and the percentage allocation should be based on an individual's risk appetite. Both GLD and SPY have substantial assets under management, reflecting strong investor demand and confidence. Additionally, they feature competitive expense ratios, making them accessible and cost-effective options for investors seeking exposure to gold and the U.S. stock market, respectively. Over the past 1 year, a $1,000 monthly investment in GLD would have grown to $13,468, delivering a 12.24% return. For SPY, the final value would be $13,579, with a slightly higher return of 13.16%. Looking at a 5-year period, a $1,000 investment each month in GLD would have grown to $82,220. This translates to a 37.03% return. Meanwhile, SPY's final value would be $91,625, achieving a larger 52.71% return. Over 10 years, GLD's investment would have grown to $203,895, providing a 69.91% return. For SPY, the final value would be $262,782, resulting in an impressive 118.99% return. The strong long-term performance of SPY can be attributed to the overall growth of the U.S. stock market, driven by economic expansion, corporate profitability, and innovation across various sectors. Conversely, GLD reflects gold's role as a stable store of value, offering more modest returns but providing a hedge against market volatility, currency fluctuations, and inflation. This contrast highlights SPY's growth potential in a thriving economy, while GLD serves as a safe haven during uncertain times. Note that the returns are indicative, may vary slightly, and don't include dividend yield, but provide an approximation for comparing the two asset classes. Finally, let's have a quick look at the key phases of divergence and similar performance between gold and the S&P 500 over the last 20 years. In 2008, during the financial crisis, the S&P 500 saw sharp declines, while gold rose as investors sought a safe haven. This was an example of divergence. After the 2008 crisis, the S&P 500 rebounded strongly, benefiting from government stimulus and economic recovery, while gold saw more muted growth. From 2012 to 2016, gold experienced a significant decline, while the S&P 500 saw strong growth, driven by a recovering economy and low interest rates. This period marked a divergence, with stocks benefiting from economic expansion and gold struggling. During the COVID-19 pandemic in 2020, both gold and the S&P 500 initially dropped, but gold quickly recovered as a safe haven, and the S&P 500 later surged with economic optimism. In the 2020-2021 bull market, the S&P 500 outperformed gold, which struggled to maintain momentum, showing a period of divergence between the two. Though there have been periods of both divergence and similarity, over the last 20 years, both gold and the S&P 500 have shown long-term growth, with gold providing stability and the S&P 500 benefiting from economic growth. Thank you for watching. This content is for educational and entertainment purposes only. We do not recommend buying or selling any of these instruments or applying any of these strategies without consulting a certified financial advisor. Subscribe to our channel and hit the bell icon for more informative content in the future.